Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Jack Miller, Global Head of Execution Services at Baird, to discuss how technologies like artificial intelligence and machine learning are impacting trading and market structure. Jack, it's great to see you as always. Welcome back to Trade Talks.
Great to see you too, Jill.
All right, believe it or not, we're halfway through the year, a little bit more than halfway through the year. Can you talk to us about what you've seen in the markets and what you're talking to clients about over the summer?
Yeah, well, look, I mean, even though we've had a bit of a pullback here in recent weeks, I think the story of the year is just how resilient market performance has been for the whole year, with popular indices led by the Nasdaq continuing to march higher, despite a number of things that were really creating a lot of fear as we entered the year, whether it's the highest inflation we've seen in a generation, the end of the free money era, a banking crisis. But markets are increasingly reflecting some optimism that despite all of this, the Fed can pull off the proverbial soft landing and avoid a recession. I think what this means for the liquidity landscape, though, overall volumes have been pretty stable, but volatility is at post-pandemic lows. Institutional activity has actually been fairly muted, as is sometimes the case in macro-driven markets. So sourcing institutional liquidity remains as challenging as ever and our top priority for our clients. But you alluded to it already, though. I mean, beyond the macro and economic data, one theme that's really coming through and we're talking about every day is artificial intelligence, which has really emerged as the dominant theme of the year.
It certainly has. So can you provide some perspective on what this means for markets?
Yeah, well, you wouldn't know it from the recent surge in interest, but AI is not that new of a field. I mean, Alan Turing, the father of computer science, first proposed his famous Turing test way back in 1950, and that became the foundation of AI as an academic discipline. But over the intervening decades, we have, computers that can play chess, that can play poker, computers that can understand speech, computers that can make music recommendations. But what's changed recently is computers that can actually create output, so creative applications, hence this idea of generative AI, which is closer to that true standard of artificial or human intelligence. And now we have computers that can write a term paper or pass a bar exam, produce art and music, write a movie script, look at the Hollywood strike. So, the maturity level where we now have, new domains of applications that are approaching commercial viability, which has wide implications for many corners of society.
I would also say, because it's so consumer facing, this generative AI, ChatGPT, it's certainly garnering more attention than things that would just be isolated to what we do in financial services. But when you think about trading, when you think about market structure, how do these newer technologies impact that?
Yeah, so again, not completely new. Certain AI techniques like machine learning have been deployed and are being deployed for some time as tools in the toolkit that we have to drive marginal gains in performance on the trading side. So this could be anything from short or medium term trading signals, predicting where and when liquidity will materialize, identifying statistical arbitrage opportunities, that sort of thing. But as I look at it in the trading world, there's really two big problems with wider adoption of AI, and one is just the sample size. So some of these models require mountains of data to effectively train, especially when you're not operating in a closed rules-based system like a game of chess. And so as a result, we've seen AI being more adopted, or more effectively adopted with what I call microstructure problems. So things where there really are large sample sizes, for example, used by brokers to tune algorithms or by venues to optimize matching logic. Much tougher on the institutional side, where the sample size is much smaller and each situation really is unique. The other problem I'd point out is this idea that I'll call determinism. So that is, you really don't know why the models are necessarily making the choices that they are. So market participants, whether that's investors or brokers, we're judged not just on our performance, but also on our narrative, i.e. the thought process. We have to explain, why we make the decisions we make and why we take the actions we take. And frankly, the model told me so is generally not a sufficient explanation, particularly when things don't go quite right. Although with generative AI, I suppose we can leverage AI to generate the narrative as well. So, maybe attitudes around this will change and pave the way for deeper disruption as we go ahead here.
And Jack, you and I typically spend our time talking about the regulatory environment and proposed changes by the SEC. What updates do you have for us there?
Yeah, well, a couple narratives that we're following on the regulatory side. I mean, first, obviously, is the market structure proposals, which are more or less in a bit of a wait and see mode now. Proposed way back in December, the comments have been filed. we've had a round of industry commentary around it, and we'll see what revisions come out of that. I think, in terms of commentary from the commission, though, no sign of wavering from the underlying motivation that drove these changes, i.e. that feeling that the current market structure has created an uneven playing field that advantages some market participants over others. Which is a premise that certainly has some validity, but if I had a concern, it would be that that's not giving proper weight to all the things that do work well in the current market structure, which has led to the deepest and most highly resilient market, in the world. Um, Other narratives, though, on the research side, we also saw the lapse of the SEC no action letter as it comes to investment research and a reversal of aspects of MiFID II in the UK. So we do have this unresolved conflict between regulatory regimes globally on how asset managers compensate research providers. And that's also something that we're watching that has uncertain implications. And then the last one that I put out, and this was just last month, not to miss out on the AI theme, the SEC has put out a proposed rule regarding predictive analytics and addressing potential conflicts of interest with broker dealers and investment advisors focused on how do these things impact recommendations that are being made to investors. So the regulators too are thinking through implications of the new technology and what that's going to mean for the business. So punchline, a lot to focus on, an interesting road ahead, and certainly something we'll all be continuing to watch and see as the story unfolds.
All right, Jack, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.